Good morning and welcome to the Morning Bell. I am Keith Harwood here for Yellowton. Excuse me. Start over. Good morning. Welcome to the Morning Bell for June 4th, 2025. I'm Keith Harwood here for Yellow Tunnel and Tradespoon. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Tradespoon, Yellow Tunnel, and myself are not investment advisors, not registered with the SEC nor FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, myself and or the team at Tradespoon or Yellow Tunnel may have a financial interest in the securities presented in the trade ideas. So please do keep that in mind as you evaluate anything that we discuss for your own personal investment or trading portfolio suitability. With that in mind, you know what, a little bit of a sideways to start the day. Yesterday, we started to get that bull run. We looked for that breakout. Bulls starting to get a bit more confidence, but it seems that this market is naturally cautious about buying breakouts or selling breakdowns. It hasn't worked for a couple of weeks. So there's a little hesitancy. Is it justified to go to the new upper range, or are we simply trying out the range, then stopping back into the range? That's been the theme for, a couple of weeks now, 2-3 weeks. Try a breakout, fade back. Try a breakdown, rally back. Yesterday, we tried the breakout, closed near those highs. Economic data this morning came in a bit weak, low ADP number. Trump now saying, well, we have to move now. We're too late. We got to lower interest rates. Some conversation about how it's difficult negotiating with China. It's not having a huge impact on the market broadly. Non-farm payrolls on Friday may have a bigger impact. Something actually happening in the U.S.-China negotiations may have an impact. Nothing happening in the U.S.-China relations and the negotiations there, or continued conversation about progress stalling, may have a negative impact. But at the end of the day, we're kind of in a waiting game. Where's that input that's going to get investors bullish? One of the old adages is that the bear needs to be fed. Right now, the bear is not really being fed. What will feed them? Breakdown in negotiations, escalation of tariffs, etc. That's maybe on the horizon. Breakdown in negotiations seems more likely than escalation, but you never know in this market if something else can shift to give us a bear move. And right now, the bull seems to be in control more than anything because the bear doesn't really have anything to hold on to other than what's already known. So getting a new known may get the bear more excited. But right now, it feels like the bear doesn't really have a new input to stand on. Bullish money flow, just general money flow that occurs into the market on a broad spectrum can allow the market to drift higher, set up a new technical range, and then maybe the computers take control and push us into that 595 to 613 range. And in the meanwhile, we look for rotation and shifts within stocks and sectors. So with all that said, I still think the probability of success right now is leaning towards the upside with the higher move. Breaking out of the range, albeit very lightly, could be a beginning indicator that we're going towards that bull market. So looking for those names that are at that inflection point, maybe participating with the S&Ps and may have a little bit further upside, and those that got a little bit ahead of the market. So those that are lagging may catch up. Those that are leading, that have been on a tear, I'm talking like the GEs of the world, those may need to consolidate if we all are doing a breakout, more so than anything because of rotation. Not because they're not necessarily bullish, but in the short term, there may be some rotation into opportunities that are breaking out of ranges. People looking for those setups that have that, now they get to be bullish move with the market if the market does go bullish. So, it's a little bit of a inflection point, not just for the market, but for the rotation element of the market. But again, I do think the probability of success and the return on capital lean towards the bull with an outright call or a call vertical. The return on capital for a put credit spread broadly is limited. Now, where those put credit spreads look like they work is actually sort of some of the big tech. They haven't participated broadly in the bull run. Yeah, Microsoft is up there, but like Apple, Amazon, Google, these are stocks that are sitting in the range still, and they allow for a put credit spread type setup. As long as the market doesn't just completely collapse, it seems like they are unlikely to collapse. They may just be a less favored side of tech that people are looking for. They're looking for higher growth names, individual names that have more exciting stories instead of this developed tech trade, at least for now. We'll see if that shifts again. It's always just kind of a moving target, a lot of flexibility required in this market. Staying above the previous high for much of the session today would be great. Getting above yesterday's high would be great. I think that would start to confirm that new range. We'll see how the morning goes. We're coming up on the morning bell here in about 5 minutes. Once the market opens, if we've got buying on the open, that could be a really good starting point. Or if we do what we've been doing, which is like this sort of handful of names, like, I looked at Walmart yesterday. I'll show that up again today. You get this buying on the open and then an initial fade and then buying throughout the day. Those are the sort of behaviors that I like to see for some of this bull story, where throughout the trading day, there's a lack of sellers. So the buyers just keep, doing their price discovery and looking for higher. So there's like a big buyer on the open, an initial fade, and then just lack of sellers allows the market to drift back up. And again, I'll look at Walmart in particular on that, because I think that's where there's a good sign of some of those indications of what we're seeing, where there's effectively a lack of sellers other than those maybe just trying to fight against the initial bull on the open, but they're not necessarily having a lot of success unless they're covering shortly after when the market starts to fall. All right. Allowing more time, I think it can be very good for the bull, because we're not into the full trend yet. So we're toying around with the idea of going into a bull trend. So allowing a little bit more time makes some sense there. And I've said this yesterday, I think right now I don't want to allow more space. My space is driven by this concept of, or my stop is driven by this concept of a bull tailwind from the broad market. I don't want to necessarily trade for holding above the previous lows, because I don't really get paid for that. I don't get a lot of money from a put credit spread there. And if I'm going into a long outright call, I can get hurt pretty bad because of the distance down to that level. So tight stop on the call, or look for the anti-bear trade with the put credit spread where I've got very well-defined support. So, it's kind of an interesting dynamic here, where instead of trying to have a put credit spread that has a good return on capital, but some decent space down to it still, is not necessarily the mentality that I've got right now. I'm actually going a little bit against this normal philosophy of saying, look, I'd like to be out if this doesn't play out, because I don't want to get whipsawed around. I want to just, be in for the bull trade. And then if the bull trade fades, I'm back to my range bound trade. But right now, if my thesis is built upon this potential for a starting bull trade, it can be negated quickly. And I don't want to be allowing a 60% drawdown in my options trade, or an 80% drawdown in my options trade just because it failed. For a long outright call, I need to have a tight stop. And then the put credit spreads, it's all just about managing the return on capital relative to the risk. So the expected value, like I mentioned yesterday, like looking at a Google or something like that, there's a decent return on capital for the put credit spread, unless the market starts to liquidate more wildly. Yeah, definitely, Fred. I'll look at the AVGO earnings. It's tomorrow after the close, but given that we've got kind of a light earnings week overall, we got a couple tonight, couple tomorrow morning, AVGO, Lulu, and Docu tomorrow after the close. We'll start to get some thoughts on there, just to kind of get ahead of it, knowing that not everybody can make it for the closing bell, or doesn't necessarily want to structure in the last half hour of the trading day right before the earnings. So we'll take a look at some of those today as well. And then, yeah, that's the beware of the earnings dates on our position. We got Mongo MDB tonight. We got 5 below FIVE. CIEN tomorrow morning, Momo tomorrow morning, ABGO, Lulu, and Doc you already mentioned. So there's a handful of the earnings. They're not necessarily going to be drivers of the market. Maybe AVGO can, being in a semiconductor space and being one of the Mag 7, Broadcom. You know, that could be a big one, but the rest of them are more independent individual names to just trade based upon their earnings, which is potentially a good thing. They're, you know, separating a little bit from the market, not necessarily trading based upon market action, trading more upon their own individual earnings results. Yeah, nothing else on this that I'm really that keyed in on, other than that, you know, this, like, the continuation trade for like a GE is starting to feel, or has been feeling like it's a chase. Scares the Jesus out of me, but I don't want to chase it now, even if it is just still a continuation trade. I feel like I've missed that if I'm trying to enter now. You know, we had some entries in GE along the way. I don't want to necessarily go all in on like a GE trade today. That move seems like it is fully mature now and likely to be reaching more of the end of its rotational shift here. It never went through like a parabolic shift. It's just been grinding out 1% a day, and that's just, you know, I think it had like an 84 RSI, something like that. And, you know, again, I'll show that one just as another example of what I'm trying to avoid right now, given the potential for risk to the downside, where a real stop for GE is quite a ways down. So unless I'm looking at that more as an investment theory of, you know, 3 6 month out options, 3 to 6 month out options, I don't know that I want to be aggressive trying to trade it for a short-term move. All right, so with that 10-year yield unchanged, 4.45. It's fine. Nothing exciting there. Nothing major shifting there, so I don't want to drag out a lot of time on it. We're staying within that range. MMFI near the highs. Good participation in this breakout, not actually to a new high on the breakout. So it's not quite buy everything. If we get towards 80 on MMFI, I get worried about the overbought condition for the broad market, where people start to say they're buying everything. But again, those 50-day moving averages are significantly lower because of what we saw about 50 days ago. The April lows are 2 trading months away, or 2 trading months behind us. That's about 44 trading days. And we're shifting and replacing low prices in the market with current prices. So the the 50-day moving averages are upward sloping, starting to catch back up to current prices. And that'll actually have an impact on MMFI, and maybe, you know, try to show some more normal behavior here in the near future. And then Bitcoin. So our risk on barometer yesterday started to show some really good signs. Today, fading a little bit. Yesterday had the higher high and the higher low, very traditional looking bull flag setup. It may just be a bounce for a day. If we get below yesterday's low, maybe Bitcoin's not quite ready to go up again. But, you know, right now we've got the inside day. Kind of watch this throughout the day. If we get above yesterday's high, it starts to give that confirmation of the bull flag, and then a potential retest of the previous highs, maybe even a breakout here. I want to watch this one closely, because right now crypto seems to be getting some engagement again, and getting it above yesterday being above the previous day's highs starts to show some interest during that market breakout. Didn't make the new high yet, but it's very, very close. And here we go. Yeah, no. So on the open, S&P is now shifting higher. Yesterday's high was 597.08, so we're above it. It's a good start to the day for the bull, the long haul trade. You know, right now the resistance I see is at 613. So yeah, it's about 2.5% away, but 2.5% is a pretty good move. Remember in May, you know, people talk through the whole thought process of, well, we had a 6.2% return in May for the market. It was widely driven by the first 2 days of May being bullish, then sideways, one good, really good day on May 12th, and then a lot of chop. So trying to find those windows where we got potential for 2.5% over 2, 3, 4 days is good. But, you know, when you get 6.2%, but it's really driven by just a couple of trading days, that can be impactful and I think indicative of what we're dealing with this market. We chop for 15 to 18 of the trading days, and the real moves occur in just a couple of days right now on little news blurbs. We start going to like, a quarter, 0.5% per day consistently, with a low VIX. That's a very easy market to you can buy in almost any time. Right now, it's about trying to time that entry point. And right now seems like the time, with my stop, as I mentioned, being that if we get back below, call it 595. Right, we get back below 595, 0.5% away, and that can happen today. That starts to tell me that it's another false breakout, and I can end up chopping myself a little bit here if I say, okay, back below 595, I'm back out. Back to 597.5, I'm back in. May have a little chop there, but the couple of times being chopped in that little range seems better to me than risking all the way down to 580 or 581 and just seeing it go against me. I might get chopped once or twice on the bull side, but I avoid the bigger risk to the downside. And that's because of the long call position that I don't want to risk all the way down to 580. And 580, by the way, $17. That was like a drop in the bucket, it felt like, in April. But right now, $17 is a big move. It's 3%. We got to keep that in mind. 3% is a pretty good size move for the market, absent what we were seeing in mid-April. Touched on this yesterday. The VIX is down a little bit more today, back down to the lows, 17.5. We're low here is 17.15, testing that level ahead of non-farm payrolls. The bull looks like it wants to take control, and people are getting a little more passive on their hedging activity. SQDEX falling, so kind of feels to me like people are starting to buy put spreads. SQDEX falling indicates people are selling further out of the money puts, and I don't think they're doing it naked. I may be wrong, but for people to be selling naked puts right now, I would think that this VIX would be dropping towards 15 or 16, making a new low. SQDEX getting back towards the lows so effectively the skew getting to the lows, the puts getting towards their lows on a relative basis to the at the monies, seems more indicative to me of people buying put spreads. And they may be out there buying calls, they may be buying call verticals. The skew index is pretty neutral here on a recent basis, so the calls relative to the puts have been staying pretty flat. So I guess based upon that, it looks like people are buying call spreads for the bull side and buying put spreads for the hedge side. Naturally, that makes some sense. We've got resistance above, we've got support below. People want the at the money option, but they're not necessarily looking for a major GE type move for the broad market. And I'll just pull up GE before I go to the next sector here, just to give you what I mean by that. People aren't looking for this to turn into this kind of move. Buying in here at 195, I expect there was probably more call vertical buying, but once we got to a new high, that's when people start to get more aggressive with outright calls in a GE. The question for me right now is, do I really get paid for selling that call against resistance? Is it a really worthwhile hedge to my position? The answer is maybe. I think it's very stock specific, and got to evaluate it on a stock by stock basis. The true stock pickers market, right? Tech up 1/3%, pretty in line here with the S&Ps. Again, new high here, resistance up at about 540, 541, another 2% away. So that's broadly fine there. And semiconductors leading the tech move again today, up 1.25%. Good sign there. That did now break out above the March 14th high. Resistance looks to be around 270. So that's got some further upside. AVGO will be key for that next week. NVIDIA had good earnings, and now starting to pay off from the good earnings after originally having a bull move, faded, now retesting the highs of the earnings move. Above the earnings day high is a very good sign for NVIDIA bull, and that's where I'm, again, looking long call rather than long call vertical, because I think there should be some light resistance around 148, but NVIDIA, when things start to go, NVIDIA does tend to lead, and I don't want to necessarily cap a move in NVIDIA, while I may want to do so in some other more timid names. And finally, small caps up about the same as tech today. but still playing around with testing a move above the May high. The May high was it 210.13? Yeah, it was the 210.13 level right now, just below 210. Session high is technically 210.01. We're pennies away. It seems natural that we're going to try above. IWM's resistance to me is closer to 225. So we've got further percentage upside in small caps if that is going to actually start to gain some leadership. Yesterday I had leadership, may have been a bit of a catch-up trade to the rest of the market. A little bit of that buy everything US-based trade in the market, and it wasn't happening in financials yesterday. Financials up about the same today as they were yesterday, with IWM up smaller than yesterday. Financials have some resistance here at 52, 52 and a half, a very slow moving general setup for financials, but seeing some small cap bullishness without having financials have to bear the brunt of that move is actually, I think, a good sign for the small cap investment, that people are looking for that value from the small caps that have underperformed and starting to allocate more in that sector. And they're not, as I mentioned, just going out and buying Apple. Apple is up 0.5% today, but Apple is nowhere near as bullish looking on the chart as QQQ. They're not going out and buying every Amazon share they can find. Amazon is just chilling mid-range. Microsoft has been good. I'll give them that. But Google, that we talked about yesterday, this looks more like a put credit spread, given that it's just not near those highs yet. Above 175, yeah, call. Because we should be looking for 190 as our resistance, in my view. But here at 167, I got a lot of resistance at 175. I got a lot of support around 163. Look to sell 162 and a half, 160 put credit spread here, and for like next week, that's priced out around 50 cents. So a 25% return on capital, risking $2, max value is 2.5, collecting 50 cents initially to make 50 cents. Do I want to do that before non-farm payrolls? Maybe. Do I want to wait till after non-farm payrolls? Probably. And the reason is because that's the input that may shift us down in the near term. Maybe a tariff announcement starts me having to pull out of that instead. But if I keep waiting for tariff resolution, which I've been trying to do, eventually I might just be waiting forever. And that also could be part of the mentality for this market, frankly. We've been waiting a long time for news, not getting it. You know what? At some point, just got to buy. And I've been waiting for a dip. And then when we get it, people may have missed out. At some point, they just got to buy. So it's a lot of the waiting game for people that are waiting eventually get tired of waiting, and then they just start to buy anyway. And then if the bearish input comes in, that could create a little bit more of a bigger pullback and frustration. But ultimately, I think over the long haul, that's the right move, is to be long the market. It's just a question of if we're going to have another dip along the way, or if we've now gone through that cycle with this consolidation, now breakout from the broad look. USO continuing higher. So we've gotten through some resistance levels here. It's nice to see. I'd like to see above 70 and a half to really confirm the oil move, but overall good. XLE looking good as a result, but has resistance around 86. So we've now bounced off of these lows. Looks mid-range, 86 target. For managing SLV at this point, I think it's switching from the put credit spread. We talked about on, I think it was Friday, like maybe a put credit spread plus a call. This is where I start thinking, okay, well, it's time to pull off the put credit spread potentially, at least if it's like this week. 33 has been pretty good support, maybe down to 32 and a half for put credit spread. A 32 and a half, 31 and a half put credit spread is only about 12 cents. So it's not bad. It's got about a 15% return on capital for next week. For this week, I don't see a put credit spread here. There's not enough premium to collect there. The long outright call makes some sense if we can retest 36, 36 and a half. And I lean towards that side of the trade now, is just the long call until we either start to dip, and then that would be a re-entry on the put credit spread, or just taking the money around 36 to 36.5 range if that continues. But now that USO is holding up, has had a good run here a couple of days, as long as that holds up and XLE is getting some money flow here, I like this for the long call instead. SLB was a good trade yesterday with a nice run. Today had a 28.5-cent dividend impacting the price action. So it looks like it's down 12 cents, but it's actually really up 16.5. All right, so take the difference of the dividend versus the move. Unchanged is basically a 28.5-cent rally here. I still have these June 6, 34.5 calls. I'm crossing my fingers. It's more of a hope situation right now. If we get a little more meat to them, then I actually have to think a bit more in terms of the real risk to it. Right now at 20 cents, it's probably not quite worth selling, not really worth buying, but going out to like June 20th or even a little longer term out to July, and then in July 11th, so I can get the dollar strikes that look call spread. That's where the 37s have enough premium to offset the premium paid for like a 35 call or a 34 call. And that's where I get a little bit more leverage. But yeah, right now, maybe a put credit spread, but more the call side of things is starting to attract a little bit more in the oil sector in general with that broad participation. And yes, resistance above. But if we continue the move that we're having, that really seemed to get started yesterday with USO continuing firm, I like holding it long here with a little bit more leverage. And again, that's very driven by this USO price being firm. If USO drops back down a $1.20, then that's that may be gone. But got to keep in mind here that USO up here is at these highs for April 22nd and May 13th, and for a catch-up type trade, that would put 35.5 or even 36.5 in the radar for SLB when oil was here last. So it seems natural that there should be some catch up here, and that could happen quickly. Yesterday, we did have a good sized move for SLB of, what was the day-to-day change? It was something like 80 cents, so 2.5%. Finally had a full standard deviation move on the implied volatility, but it's, based upon recent historical volatility, it's about 2 times the normal move we've been seeing. So getting some participation, finally, maybe we get a little bit more of a spike. But again, I like the outright call here or the call vertical in SLB, depending on the time frame. Got to get paid enough to justify selling the 36.5 or 37 call, and I don't get paid enough, I don't think, out to like June. Just not a huge fan of selling a 19-cent call. But out in July, if I want to look a little longer term, 37.5, sorry, the 11th, so I get the dollar strikes. The 37 calls can certainly be sold against a 35 call or even a 34 call long position. Let's run through, and actually I haven't rechecked the SLB forecast toolbox for this morning to see if it's still looking at like 35 or if yesterday's price action gave a further upside here. So model grade B trend 1.13%, very bullish indication for today. Upside looking at 30, still about 35.25. So, kind of still looking for that same potential upside. Forecast toolbox isn't looking for 36, just to keep that in mind. It's looking for 35 and then a potential for a fallback. What's it got for crude oil? You kind of hang in the range. So we'll see. I mean, this is going to be the real driver, I think, of whether these SLB, XLE, OIH, ExxonMobil, et cetera, trades continue to perform is really going to be if USO can move out of this range boundedness, continue to firm after now testing a breakout to the upside. Our 3 aggressive power trader names for today are AVGO. I mean, I'd look at this for just a pure earnings play, and actually with this run, I'm becoming less inclined to do a big earnings play in AVGO. It's starting to remind me a little bit of CRWD. The run up pre-earnings and then the normal 7% drop right on earnings. It becomes more of a symmetric move potential for me. CRWD looks like it's holding up just fine, maybe like PLTR, where the earnings came in a little disappointing and then it rallied off of it anyway. That may be the net result for like CRWD. AVGO now getting into this more aggressive buying stance ahead of earnings. Yikes. Let's see what the forecast toolbox says, knowing that it knows earnings is coming. B model, I mean, it likes the upside. Looking for a pretty flat to slight pullback on earnings, followed by fall through to the upside. With that sort of setup, if we get the dip, maybe I look for a setup similar to PLTR, where once we start to fill the drop, then I can go long. I wouldn't be surprised to see it down to 240. Earnings in AVGO is normally about 8%. We've seen bigger, particularly recently. I'm kind of leaning towards 10-ish%. The market's leaning towards 6%. 10% from current prices would look like 240, right near the highs of the range where we broke out, or up to 285 if it's bullish. Given that we already had such a run, I don't know that I can see a justification of like a 15% rally. They got really spread open interest here. So I'm kind of, my lean is to think that on the bear side, 240 or 237.5 would be a target range. And with implied volatility at 48, expecting to drop to 40-ish, maybe 39%, the calendar looks decent here. So the June 13th options are at 67%. Where I normally do a quick eyeball check for if earnings calendars are overpriced is if the June 13th implied volatility is more than twice the level I expect it to be after earnings. So in the sense that I'm expecting this to drop down towards 38%, I'd say calendars are expensive if this vol was 80, 85, 90. It's a 67. So giving me a little bit of an indication here that maybe the calendar is the play, both on the call or and the put side. In like a 235 put calendar, leaning out to honestly, it probably is just the 1 week, given the vol levels. 2.5 versus, so it's like $1.13 on the put calendar. 285 now is 235 versus 386. They have $1.50. It's $3 for a double calendar. It's not cheap, but that may be the best we can do. Honestly, I would not be surprised. Vlad will check in on it here, but he was in the 280 call calendar for $1.20. I wouldn't be surprised if that ends up actually getting taken off prior to earnings, given that it's already up to 330 versus 502, so $1.70. Good return. $1.70, I wouldn't necessarily be aggressively buying. It's starting to get pretty expensive. If we continue on the bull run today, maybe it's just to take the profits, good 50%, nearer 50% return on the calendar. The put credit spread can be taken off for effectively another nice win there. I don't know that I'd pull all the way through to earnings, given that we've already now run up into the earnings. It might just be a better spot to take the money early. So we'll see if AVGO shifts a little bit here prior to earnings and throughout the trading day today and tomorrow. But right now, I think a double calendar is about the best we can do. It's just not hugely leveraged. All right. Other aggressive power trade names, we got Boeing. Boeing broke out yesterday. Sort of broke out on May 29th, but then fully got back above that high yesterday, chilling near the highs. Stock forecast toolbox. There we go. A model grade, that's a really nice level. I like seeing a high model grade like that. You see the probability at 94% for the low high. That's a really strong predictive level. So the model feels very confident about Boeing and looking at this potential for the near-term future, giving some nice upward vector. So right now, maybe a little bit of a consolidation range bound trade. A little bit of a range. If we get near the lows of this range around 212, right now we're right at it. It looks like a good entry point with a stop out below 209.5. So for the day, maybe a good entry point. I think giving it a little bit of time, given that the next few days, we're expecting a bit more chop going up to the July options, and maybe keeping it simple with like a 215 call. The implied volatility is at the lows, so I don't really want to go for like a put credit spread saying that 200 should hold, because I don't really get paid for staying above 200 for a week. 15 cents, that's not enough money. But going for a long outright call near the highs with the breakout, 215, maybe a 210 for July, that could give me some good payoff with upward momentum. I think it's just kind of managing the range. Around here, it looks like a good potential entry point based upon our forecast toolbox. NEM, I'll tell you right now, I am not a fan of the bull gold trade personally. When we look at FXY, it is up a little bit today, but it's been chopping. It's now testing the 10-day moving average again. Every time we try to get up to 65, it drops back down towards 63.5, 63. Gold, every time we try to break out above 310, fades. Today it's pre-sideways. SLV is getting hit again today, a little bit. Had a big gap up, now pulling back down here. If I see SLV up to a new high above 31.5 or 31.60, then maybe the NEM trade starts to look more attractive, where people are getting into some of these gold miners, silver, etc., for that further upside. So, I think watch silver for the NEM. The NEM and the gold miners chart looks a lot more like silver than gold right now. So if we're seeing silver bullish, it means to me that people are that much more into this idea of going long precious metals, and then that's when NEM could really shine. It should have some resistance at 57, so I don't expect a rapid move from 55 to like 60. I'm looking for this to potentially start to show some signs of bullishness, and then above 56, that could be a better entry point than just buying in right now. The forecast toolbox, by the way, for NEM shows a B model, flat day, a bit of chop with some resistance around that 57 level, highs of 56.5. For silver, it's showing, kind of similar, with the bigger next move potentially coming next week. So again, non-farm payrolls may be the thing that moves silver and gold, but it can move it either way. So there's a lot of risk associated with precious metals on the non-farm payrolls number. I've seen that cause some big moves in the past. So if you don't want to run it through non-farm payrolls and take that coin flip risk, then that's one that I would probably look to avoid here. I think Boeing buying in around now looks better than any of the other aggressive power trader names. All right. Before I go to earnings, I just want to show you what I was looking at for like Walmart again. So in the last week or so, and actually it wasn't there today, but we had buyers on the open and then sideways, buyers on the open, then get faded, buyers on the open, then get faded, but then buyback throughout the day. Today, we didn't have the aggressive buyer on the open. I don't so far see the aggressive selling off of that buyer. Buy around an hour from now, if we're drifting up higher, as we have been. It started at around 11 o'clock yesterday, at around 10:30 on Monday, and there was not much pullback here, but then the buying came in later. I wouldn't be surprised to see Walmart continue to show that just throughout the day, a little bit of buying action. We are above the highs right now. 100 is a big number because it is usually a number that you get a little bit of fight around. We tried to push through yesterday with general ease. If we push through it again today and get a little bit of distance from 100, that seems like that would be a really strong signal for some upside here in Walmart. I do actually still have my June 27th 103 calls that wasn't sure if they were going to play off, and now I like that structure. I mean, for me, I'm looking for Walmart to get back towards 105 if this bull run comes through. And so like a 102 to a 103 call gives me some nice leverage. I may be better off being in the July 3rd or the July 11th just to give a little bit more time. Again, July 18th, I only have $5 wide strikes, so I don't like the July 18th option structure, but having a couple of extra weeks would be nice. The markets will tighten up on this stuff here throughout the day. This is kind of crazy, the $1.50 wide market, but those are about $1.50 for the July 11th, about $1 for the June 27th, just under right now. And I like Walmart. I think that this is a stock that looks generally positive. XRT has started to show some good signs of breaking out, very similar to Walmart, pulling back a little bit today. If we see some of that bullishness in retail again through today, where that's another sector that's getting allocation, that should provide that tailwind. So kind of watch the XRT stuff. Walmart for our forecast toolbox, A model grade, slight positive. And you see that, you know, the forecast toolbox likes this concept that we're going into a bull run. So, I mean, if I get 6%, if I test 106, or even, you know, if it's good, you know, 10 days from now is less likely to be 100% accurate than, you know, today we have a higher probability of accuracy. But if I get a 6% run in Walmart, my June 27th 103 calls are gonna explode here. So that's a nice look to both the chart and the predictive AI elements of it, and so it gets me excited a little bit more with that. Any others that I wanted to touch on? Bitcoin pulling back a little bit today, as I mentioned, and that's hitting all the crypto names that were starting to get money flow yesterday. Not too bad for HUD-8, for example, only down 8 cents, but MSTR always seems to need to be a part of it when people are buying there. Wow, Palantir getting a pullback right now. So Palantir down about 4% now. I guess people aren't aggressively buying AI this morning. That's going to be something to watch. If Palantir gets below 125, it could be a sign of something worse. If I see this stabilize, 120 is a good put credit spread once it stabilizes. You know, 23 cents for the 120, 119 put credit spread for next week. Probably not enough money this week. You know, 11 cents, 12 cents. If this stabilizes and starts to show some buying, maybe a short-term put credit spread for Palantir. But again, know that non-farm payrolls or tariff negotiations may have an impact on Palantir and broad market behavior, just because it's such a loved stock. There's a lot of bulls out there. If they have to liquidate, it could create some significant downside. That said, we didn't really have that significant downside here. We had it in February, right? Looked like nothing but a bull run, and then it just popped back down after February 19th. So, but right now Palantir is leaning towards setting up a put credit spread. It's just down a little much right now for my taste to sell the put credit spread yet. If we keep going down, I don't think it's a put credit spread today. If we stabilize and bounce back towards 128 and hang there for a little bit, then it becomes better setup for a put credit spread. That's a good question. What is wrong with BSX? Now, so BSX, that was on the weekly power trader list for this week. I think with BSX, this is a put credit spread setup to me. 102 looks like a really strong support. It's just not what people love today. You know, when it had its great run in January and into February, everybody wanted it. I think a lot of this chop up behavior scared some people around a little bit. I don't know why people wouldn't necessarily love or why they might dislike it here. Could just be that it's been on such a nice run over the last 6 months, having gone from $90 up to 106, that people are looking for bigger opportunities with higher potential returns. 102 to 106, it's only 4%, but then the market, it's a little bit more than the market return for a move back to highs. But in any case, like a BSX seems like a put credit spread setup, 30 cents for the week on the 102, 101, 22 cents through the end of the week. That's tempting. Actually, that's really tempting for this week. How did non-farm payrolls do for BSX back in August 4th? So we dropped from 74.5 to 73, so about $1.50 impact when we had the August 4th non-farm payrolls that created some real fear in the market. We dropped nearly actually only 60 cents initially, a little fall through and then a bounce. So BSX doesn't look like it's as broadly impacted by non-farm payrolls. So that may be better. I'm just basing this on a couple of data points, so I'm not doing a full every non-farm payroll impact on BSX, but it looks to me like a credit spread more so than anything. It's holding the support level. It's held it multiple times. It's testing it now, but there's nothing that seems to be triggering a major selling here other than maybe just it's not the stock that people are pulling up to buy right now. So I wouldn't say it's anything wrong with it. It's just being ignored or forgotten for the short term. But that could be, like I said, a good opportunity for a credit spread. All right, let's run through some of these earnings names. So we got Mongo. Mongo normally moves about, there we are, 16%. Last 4 earnings have been a low of 17%. Highest was 27%. So if I go off of the 2-year, the average move is 17%. If I just look at the last year, this looks like a 20-ish% move. So call it about 20 bucks. 215 lines up with the high of the earnings move. It was 212, I guess. 215-ish for the high since the last earnings that were bad. And 20 bucks down puts us at 175, right in line with the 50-day moving average and right in line with this part of the range. I'd lean towards a $20 move. The implied volatility should drop down to about 45. Calendars are expensive, right? So this is a big mover on earnings. The calendars get very expensive when we have that expectation for a big move on earnings. June 13th implied volatility is 118. It's got 70% downside. So I just go for a fly type situation. We're pricing in a $27 move in Mongo database, as you can see. $13.50 on both the call and the puts. I don't agree with this expectation. Oh, sorry. 20% is $39. Did it off of, I did $20, not 20%. So 20%, there we go. 235. That lines up with the December lows, like 230 range. That makes more sense. Sorry about that. 155 on the lows. All right, now we're cooking with gas. There's a little bit of clustered open interest here at 150, 155. Very little open interest on the call side. Up in the range that I'd be looking to target. The double fly is not expensive, like a 165, 150, 135, getting it nice and wide. It's $1.20. So about 8% of the max value. So if I have to pay like 15 to 20% of the max value of a double fly, that's a decent R&R. Requires some movement. But if we go 40 bucks up to 235, the 220, 235, 250 call fly, yeah, another about $1.50, so $3. Max value is 15. I'm not going to get to 15. I might get to 12 if we get a move. As long as we move 10%, I feel pretty good. If we move less than 10%, I'm hurting a little on that. 10% would seem like a very small move for Mongo database given recent performance. Even in the last year, the two small moves were 7% and 3%, and then 11%. So I think a double fly for Mongo database makes some sense, targeting say 150 and 235 or 240, and then being a little bit wide with it, 15 bucks wide. That way I get some big range to potentially capture. So about $3 for the double fly when doing that way. 5 below, retailers sitting at highs. Normally moves around either 12% or nothing. So the nothing trade I can't bet on, but if I want to play for the 12% move, 15 bucks, 105 on the downside, right here at the support where we dipped and then bounced off. Looks like an okay target. Oh, we don't have weeklies in this. Oh, we have weeklies in 5 below. All right, well, we don't have weeklies. We do have some decent volume here. But without the weeklies, I guess I'll just say, never mind. We can pass on 5 below. Sienna, I'll double check for weeklies before I, nope, no weeklies. Momo may not have weeklies either. No weeklies. Yeah, all right. So most of these things are just kind of boring. So we'll go into tomorrow afternoon's earnings instead. That's where the excitement is. So we did AVGO already. Let's go Lulu. Lululemon, $335 stock, looking to break out of this range. Filled that earnings gap in the last couple of weeks. That's good for them. Let's see. So we're at 335. The earnings normally moves around 6% or 16%, or call it 15%. So it's either 6% or 15%. One outlier of no movement at all. So if I'm playing in Lulu, I got to be basing it off of a potential for a 15% move, not off of a 6% move. No, it's a coin flip that we might move 15%. We might only move 6. 15% is 50 bucks. So up to 385, right back into the higher range. 285, right back into the pre May 12th gap up move. So 285 and 385 are kind of the targets here for Lulu. Not a lot of open interest again. Moves a lot on earnings. Pricing in a $30 move, and I'm looking for 50, like I said. 300, 285, 270 put fly. 340 minus 265, so 75, about $1. That doesn't look bad. Going for the 370, 385, 400 call fly, about $1. So I pay about $2 for two $15 wide call flies. That gives me a good window for profit. I actually like that one. I'm gonna look through that one a little bit more today and tomorrow before earnings, because that one seems like a really good risk reward. I need to get at least 10%. So similar to MDB, I need at least 10% to hit my profit window. But we've had a lot of 15% movers. If we only move 6%, probably lose on this. But if I think there's a 50% chance we move more than 10%, which is about in line with what we've seen historically, then that seems to line up pretty well. We get the 15% and I hit the jackpot, but the double fly here does look to be lining up given the outlier move potential here, where paying $2 for something that I could probably be peeling off for the winning side for maybe as much as $10 or $12 if I get really lucky. And I think it would be at least, $4 if we only move 10%. So that seems like a really good positive R&R where, sort of the expected value if we get that 10 to 15% move is something like $9, and that could happen half the time, then it's underpriced at $2 for the structure, right? $1 for each fly. So I like Lulu for the double fly. And then last one we have DocuSign. Yep. DocuSign, like the rest of the market, just towing against the highs for the potential breakout. The earnings normally moves about, for a long time it was 4%. The last two earnings have been really volatile. If we get a return to normalcy, 4% puts us at 90, probably 96.5. 8.5 roughly on the downside. The wild move, based upon the last two, maybe we do see another like 10% like the market's pricing in. It'd be like 101, 102. I think you'd have some serious resistance at 100. There's not a ton of open interest. This might be setting up more for the iron condor, where I look for it to stay less than 12%. Selling a 104, 105 call spread for 15 cents, selling an 81.80 put spread for 13 cents, so collect about 27 cents, and expect that as long as we stay in the range, which should happen more than 75% of the time, I have a positive expected value. And that's for a 12% move. If I go back for the 2 years, yes, the last two both did that. But if I go back out like 5 years, 12%, I guess was kind of the norm in 22, 23. Just that low volatility for that last like year and a half kind of screws with my thought process a little bit here. I lean towards iron condor, but I may be proven wrong. If this has a huge move more in line with what it did before, more than 2 years ago, and what it did the last 2 quarters, then I'm dead wrong here. But it seems like that was the natural lean, was to move this more towards smaller moves, and the iron condor would be the play in that scenario, I think. Maybe the double calendar. Now, implied volatility should drop to like 38%. Yeah, so the double calendar is not going to work. I think the iron condor is the best we've got here. We don't have a big open interest specific strike that would set it up. I think Lulu is the better trade. Docu is a potential with an iron condor, but I think Lulu is the best of the bunch for earnings for tomorrow at this point. Lulu, I think right now, kind of just peeling back on AVGO and reevaluating tomorrow. I'd actually rather, there may be a better trade in AVGO if we can get back to like 250 pre-earnings, then it may be setting up something a little bit more interesting instead of trading at the highs already. But where it's sitting right now at 260 and this bull run, I think I'd avoid the AVGO for now and focus on Lulu, maybe Mongo database, and an outside chance of DocuSign with the iron condor. Right, it's up today. That's a little surprising. Oh yeah, so here you go. SLB up 6 cents means it's really up 33.5 cents. So this is a good sign. We're trading above that high once factoring in the dividend. Looks generally like the bull momentum is still there with, yep, oil is up 50 cents now. So continuing that bull move in oil is nice to see. If oil continues to firm here, it starts to look to fill those gaps and get, another 3-4%, and that should be very constructive for XLE. So like, ExxonMobil has a lot of upside here to 110, CVX has a lot of upside here to 145, well, some upside here, I guess, to 145. Occidental, I always like pulling it up because that was one of Warren Buffett's, big positions, 45. Actually, ExxonMobil might be the real winner here at 105, going up to potentially 110. What's the, yeah, I mean, there's decent R&R there with like the 10, get it an extra week. 107, 110 call spread in ExxonMobil for 85 cents. It doesn't look too bad. It's very much the leverage trade, but with it having some potential room to run here to get to 110. I like ExxonMobil here while on this rotation back up, getting above the recent highs, and then that range bound bull, like saying we go from the low end of the range to the high end of the range, and maybe have continuation above if oil does continue on its current bull trend trajectory. All right, anything else that was moving this morning that I needed to highlight? Nothing in there. Dollar Tree was weak on their earnings. So Dollar General had the good earnings. Got up to 113. And then Dollar Tree threw a little bit of a wrench in that and drops 10%. Broke through some of the main support levels, bigger than normal move here. Now at 10%, usually looking for about 8. Definitely surprised the market here after the run up yesterday. So, I think that like sort of perfectly illustrates the stock selectivity part of the game. It's like these two stocks seem like they should always be trading and economically almost, like lined up together, Dollar Tree and Dollar General, and yet one had bullish earnings and the other disappointed. So it helps push people towards, I think, stock picking instead of broad buying or sector-based buying from the earnings. Now the follow through going forward, I expect this to mean that Dollar General gets more money flow in the future. Dollar Tree has a lot of work to do, has to get back above recent highs in order for people to start getting excited again. And there may be a shift that direction, but now they're kind of like Uber versus Lyft. Uber pulling back a little bit here. But remember, Lyft had the really positive earnings. And then even though they had the pullback, that earnings has set up Lyft in the near term, I think, to be the better performer than Uber stock because they had the strong earnings. So people more apt to look for dips to buy in Lyft than in Uber. Same kind of idea for Dollar Tree and Dollar General going forward. Yeah, let's see here. 1 second. Before, I don't know if there's anything that anybody else has majorly here. As I said, so yeah, Vlad took off the AVGO call calendar. No surprise there. $1.65. So in at $1.20, out at $1.65, doesn't have to take the earnings risk. So that makes a lot of logical sense to me. Potential re-entry tomorrow instead of worrying about it today. IBM, yeah, looks like Vlad just closed that. Yeah, so towing against the resistance. I think the idea makes sense here, getting to buy at the bottom of the range, sell near the top end of the range, and then rebuy on a breakout or a dip. So this goes back to that sort of option structurally above highs. I like a long call, back around 260, put credit spread or stock, right? So for those that just want to trade stock, I'm looking at buying in the 258 to 260 range, stop out on a breach of 256.5, we'll call it, give it a little extra room, or break out above 269 getting long again, and likely with a call option to get the leverage as well as the defined risk in case we just do a quick flip back around here, or if it's like this breakout where we get a quick move up to take some profits. But I don't want to necessarily get long stock without a stop element on the new high. So it's either a very tight stop or a long call to get that extra leverage. The implied volatility in IBM is, 6-month lows here. So, and we've been realizing right in line with that. So just enjoying the fact that it gives me the defined risk and the leverage without having to pay a premium for it is, I think, generally a comforting feeling for me. Yeah, this is like exactly where, that's it, Fred. Like, this is exactly where I'm like, perfect, watch list. Go higher and I can buy a call, go back down, I can sell a put credit spread. Right here, good to take the money. And it'll be the same thing, like if SLB does follow through and gets towards like 36 and, well, 35 and a half to 36 range, it's like take the money. And if we go above 36 and a half, back with another long call. And if we dip back down towards, well, if we go up there and then you dip back down towards 33 and a half, put credit spread again with maybe a pairing of a long call at that point, but I don't want to have any real position at around 36 bucks because then I'm just completely at the inflection point. We could have a quick pullback or we could have the quick follow through. And if we have the quick follow through, I just have to be on top of it to buy in when it happens. So yeah, IBM is setting up perfectly for that kind of setup where it's watch it, and be ready to act. If we pull back, great. Probably takes a couple of days, so it would be more of a put credit spread, more likely next week. But the call trade may come through here in the next couple of days. May even be today. Well, maybe not today, because to get above the previous high today, then I'd be up 1.5%. So already a full standard deviation move. So maybe tomorrow for a long call. But yeah. Review last time to make sure I didn't miss anything on my list here. No, I think that should be good for now. Oh, did just see a name here we were looking at last week. It just keeps going, doesn't it? For those who feel like you missed the Mosaic, I mean, Mosaic, CF, these things just look like GE, don't they? CF is a little bit behind it, but man, people love these fertilizer companies right now, hydrogen, nitrogen fertilizer. Boy, wish I had noticed that you started looking at CF or Mosaic again back in like, end of April, because I had not looked at these in honestly a long time. Used to be a market maker in CF when I was on the floor at the CBOE, and these were some crazy stocks to trade as a market maker. Not necessarily the most profitable for the market maker, because they just had such whipsaw moves at times that it seemed like people knew what was coming when they were coming. But this has certainly been on a tear. This is a perfect example of a stock that I don't really want anything to do with. With the RSI at 83. I mean, I can put support at 36 and say at least then I've got a defined risk stop. But it feels dicey trying to get in here on continuation after all the continuation we've already had. And it may just be that it's a long-term bull trend. I mean, if I go back, sorry, I was going to say, if I go back on a 5-year chart in Mosaic, had much higher prices back in 22. You can see it does have some ability to take long-term trends in there. So maybe it's just shifting into that being one of those long-term trends, I guess. I don't know. But that's one that I'd say scares me a bit here. We'll see how the rest of this week plays out for Mosaic. And then I think, like I said, if you like it, because it is breaking out here, This is just the RSI scares me a little bit, but it is breaking out. And then I'd look for a stop out at 36 for Mosaic. Oh, Kramer mentioned it yesterday. Yeah, that's a bad sign. I don't know how many of you guys watched Kramer's Mad Money stuff back, about 20 years ago. He had huge impact on stocks. Anytime he put something on Mad Money, it immediately moved. And somebody, after a couple of years of data, did a back test and said that if you sold his bullish calls on the open the day after he called them, because they always moved, you had this really beautiful P&L chart where like a hugely high percentage winners and all, it was just a really great trading strategy to fade the move. So the market moved the price too far basically on his answers. It wasn't that necessarily he was wrong about being bullish. It's just that if you tried to buy in after the call was made, you were too late. So he may, if you took the price before his call, that may, or before his whatever his bullish call on it, he may have been fine. But by the time anybody retail could enter into it, it was the move was already more than priced in, and too many people chasing it. Oh, he was negative on MOS. Okay. Yeah, so I think the disaster at the beginning may have been partially because people were so like, focused on trying to chase all of his trades. And that made it a little bit harder. Either that or, people were taking advantage of it, exactly like I said, where people started recognizing that they should fade these moves. When you get a stock move 10% because he's bullish, that's, a pretty big impact for an individual dude. He shouldn't be be able to move a stock by 5-10%. He should be able to move it by 0.25%. He's still a CNBC talking head at this point, right? More than an investment manager. For like a Warren Buffett being bullish, it has a lot more impact to me than Jim Cramer being bullish, right? Or a activist investor getting involved should have a much bigger impact than somebody making the call on CNBC. So, all right, guys, I'll let you go because it is after 10:30 Eastern here. But best of luck today. Hopefully, we get some more fall through in these oil names because I still have my SLB calls. But otherwise, more than anything, just continuing to monitor here. I like that Lulu trade idea for earnings tomorrow afternoon, but we got time on that. And we'll just see if this market can continue to the upside after, again, making a new high today, which is a good start to the day. So it looks like a bull run day. Thanks again, everyone.